Question 1. Regulatory environment. Which of the following is a key requirement for obtaining a captive insurance license in Montana under the Montana Captive Insurance Act? A. Captive insurance companies must demonstrate compliance with both the Dodd-Frank Act and IRS regulations as part of the application process. B. The applicant must submit a comprehensive business plan outlining the captive's proposed operations, financial projections, and underwriting strategy. C. The captive must have a minimum surplus of $2 million in place before submitting its application to the Montana Department of Insurance. D. All captives in Montana must operate as Risk Retention Group or RGS, regardless of their structure or business model. Answer. B. The applicant must submit a comprehensive business plan outlining the captive's proposed operations, financial projections, and underwriting strategy. Explanation. When applying for a captive insurance license in Montana, the applicant is required to submit a comprehensive business plan that includes the company's proposed operations, financial projections, and underwriting strategy. This requirement ensures that the captive has a clear plan for operations and is financially viable. While compliance with the Dodd-Frank Act and IRS regulations, Option A, is crucial for federal compliance, it is not directly part of the application process for obtaining a license in Montana. The minimum surplus, Option C, can vary depending on the type of captive, and Montana's regulations do not mandate that all captives operate as RRGS. Option D. RRGS are just one type of captive insurance structure. Question 2. Scenario-based question. Mr. Thompson has decided to establish a captive insurance company to manage the risks of his manufacturing business. He has identified the need to cover operational risks, including liability and business interruption. He plans to form a single-parent captive in Montana. What is the first step Mr. Thompson should take in the process of forming his captive insurance company? A. Submit the application to the Montana Department of Insurance, as the formation of the captive is a straightforward process. B. Conduct a feasibility study and obtain an actuarial assessment to evaluate the financial viability of the captive. C. Immediately fund the captive with a minimum capital requirement of $5 million to meet Montana's statutory capital surplus requirement. D. Hire a captive manager to begin the day-to-day operations of the captive and develop underwriting policies for the business. Answer. B. Conduct a feasibility study and obtain an actuarial assessment to evaluate the financial viability of the captive. Explanation. Before forming a captive insurance company in Montana, Mr. Thompson should first conduct a feasibility study and obtain an actuarial assessment to evaluate the financial viability of the captive. The feasibility study helps assess whether a captive is the right option for managing risks, considering factors like premium costs, underwriting considerations, and potential claims. This step is crucial to ensure that the captive will be financially sustainable. While applying for a license at Option A and hiring a manager, Option D, are part of the process. They come after the feasibility study. The minimum capital requirement, Option C, will depend on the type of captive, but it is not typically the first step. Question 3. Taxation of captive insurance. Which of the following is a key tax advantage of using a captive insurance company in Montana? A. Captive insurance companies in Montana are exempt from paying state income tax on all premiums they collect. B. Captive insurance premiums paid to the parent company are not deductible under federal tax laws due to the related party transaction rules. C. The premium payments made by the parent company to the captive may be deductible as a business expense under IRS Section 831. B. Provided the captive meets certain criteria. D. Captive insurance companies in Montana must pay federal taxes on income generated from premium collections, regardless of their operational status. Answer. C. The premium payments made by the parent company to the captive may be deductible as a business expense under IRS Section 831. B. Provided the captive meets certain criteria. Explanation. Under IRS Section 831, B. Premium payments made by the parent company to its captive insurance company may be deductible as a business expense provided the captive qualifies. This allows businesses to reduce their taxable income by deducting premiums paid to the captive. Option A is incorrect because Montana does not provide a blanket exemption for captive premiums from state income tax, that they may still be subject to state taxation depending on the structure and type of business. Option B is incorrect because premiums paid to a captive can be deductible under certain conditions, even if the companies are related parties. Option D is also incorrect because the tax treatment of a captive depends on its operational status, and not all captives are required to pay federal taxes on their premiums. Question 4. Regulatory environment. Which of the following is true regarding the annual reporting obligations for a captive insurance company licensed in Montana? A. Captive insurance companies are required to file only financial statements with the Montana Department of Insurance once every 2 years. B. Captives must submit both financial and operational reports annually, including claims data, to maintain compliance with Montana's regulatory requirements. C. The Montana Department of Insurance only requires captives to report their financial solvency every 5 years unless there is a significant change in their operations. D. Captive insurance companies in Montana are not required to submit claims-related data, only financial statements, as claims are considered confidential. Answer: B. Captives must submit both financial and operational reports annually, including claims data, to maintain compliance with Montana's regulatory requirements. Explanation: Montana law requires that captive insurance companies submit both financial and operational reports annually. These reports must include detailed information such as the company's financial condition, underwriting activities, claims data, and any changes in operations. The Montana Department of Insurance uses these reports to ensure ongoing regulatory compliance and solvency. Option is incorrect, as captives must submit reports every year, not every 2 years. Option C is incorrect because solvency assessments must be continuous and captives are required to file annual reports. Option D is incorrect because captives must report claims data, as it is crucial for regulatory oversight. Question 5. Risk retention GRGS. Which of the following best explains the main advantage of a risk retention GRG over a single-parent captive insurance company? A. RRGS offer more flexible regulatory oversight, allowing for greater risk diversification and broader product offerings. B. RRGS provide insurance exclusively to its members, who must be in the same industry, resulting in lower premium costs and shared risk. C. RRGS are exempt from state-level insurance regulation in all states, making them an attractive choice for business owners looking for less regulatory burden. D. Unlike single-parent captives, RRGS allow businesses to reinsure the risks of unrelated third parties for a profit. Answer: B. RRGS provide insurance exclusively to its members, who must be in the same industry, resulting in lower premium costs and shared risk. Explanation: a risk retention RRG is a type of captive insurance company that is owned and operated by its members, all of whom must share a similar industry or risk exposure. This structure allows RRGS to pool risks, leading to potentially lower premiums for members and a more diversified risk pool. Option is incorrect because RRGS generally face more stringent regulations than single-parent captives, especially with regard to their business operations. Option C is incorrect because RRGS must comply with state-level regulations in the states where they operate and cannot avoid such oversight. Option D is incorrect because RRGS provide coverage only for their members and cannot reinsure unrelated third parties for profit. Question 6. Claims management and loss reserving. Which of the following best describes the role of actuaries in the claims management and loss reserving process for a captive insurance company? A. Actuaries are responsible for establishing claims reserve levels based on statistical analysis and historical claims data to ensure financial stability. B. Actuaries are primarily involved in the claims adjudication process, making decisions about whether or not a claim is valid under the terms of the policy. C. Actuaries monitor the daily claims management operations and handle the resolution of disputes between the captive and its insured parties. D. Actuaries determine the premium rates for the captive's policies based on regulatory guidelines set by the Montana Department of Insurance. And so A. Actuaries are responsible for establishing claims reserve levels based on statistical analysis and historical claims data to ensure financial stability. Explanation: actuaries play a key role in the claims management process for captives by using statistical methods to establish claims reserve levels, which are funds set aside to pay for future claims. These reserves are essential for ensuring that the captive remains financially solvent and can meet its obligations. Option B is incorrect because while actuaries contribute to underwriting and risk assessments, the actual claims adjudication, deciding if a claim is valid, is typically handled by claims adjusters. Option C is incorrect because daily claims management is the responsibility of the claims department or third-party administrator, not actuaries. Option D is incorrect because premium rates are determined based on risk factors and actuarial assessments, but not directly by regulatory guidelines. Question 7. Financial and actuarial considerations. A captive insurance company in Montana is trying to assess its liquidity position Which of the following would be the most accurate indicator of the captive's ability to meet its short-term obligations? A. The captive's solvency ratio, which compares its total assets to its total liabilities, provides the best indication of liquidity. B. The liquidity ratio, which compares the captive's current assets to its current liabilities, is the most accurate measure of the company's short-term solvency. C. The premium to surplus ratio, which compares the premium income to the captive's surplus, indicates the captive's ability to meet its operational costs. D. The operating income of the captive, which reflects the company's profitability, is the primary measure of its ability to cover short-term obligations. Answer: B. The liquidity ratio, which compares the captive's current assets to its current liabilities, is the most accurate measure of the company's short-term solvency. Explanation: the liquidity ratio is a key financial metric used to assess a company's ability to meet its short-term financial obligations, including claims and operating expenses. It is calculated by dividing the current assets by the current liabilities. A higher ratio indicates better liquidity and the ability to cover short-term debts. Option A is incorrect because the solvency ratio measures a company's overall ability to cover long-term liabilities, not short-term obligations. Option C is incorrect as the premium to surplus ratio assesses capital adequacy and risk retention but does not directly measure short-term liquidity. Option D is incorrect because operating income reflects profitability but does not directly indicate a company's ability to meet short-term obligations. Question 8. Captive insurance products and coverages. Which of the following is typically not a type of coverage offered by a captive insurance company? A. Workers' compensation insurance for employees of the parent company and affiliates. B. Excess liability insurance that provides coverage beyond the limits of the parent company's existing commercial policies. C. Life insurance policies for the parent company's employees as part of an employee benefits plan. D. Health insurance policies for the parent company's customers and unrelated third parties. Answer: D. Health insurance policies for the parent company's customers and unrelated third parties. Explanation: while captives commonly offer a wide variety of insurance coverages, including workers' compensation, excess liability, and life insurance for employees, they typically do not provide health insurance for unrelated third parties or customers. Captive insurance companies are designed to insure the risks of the parent company and its affiliates, and offering health insurance to unrelated individuals would likely fall outside the scope of the captive's original purpose and business plan. Option is correct because captives often provide workers' compensation insurance for the employees of their parent company. Option B is correct because excess liability insurance is a common offering for captives designed to cover amounts above the parent company's existing policies. Option C is correct because life insurance for employees can also be covered by a captive as part of an employee benefits plan. Question 9. Risk management and underwriting. A captive insurance company decides to reinsure a portion of its risks with an external reinsurer. What is the primary purpose of this reinsurance arrangement? A. To reduce the captive's taxable income by transferring liability to the reinsurer. B. To provide the captive with additional capital to meet regulatory requirements set by the Montana Department of Insurance. C. To mitigate the financial impact of large or catastrophic claims by transferring some of the risk to the reinsurer. D. To allow the captive to offer low premiums to its members by sharing underwriting profits with the reinsurer. Answer: C. To mitigate the financial impact of large or catastrophic claims by transferring some of the risk to the reinsurer. Explanation: reinsurance is typically used by captive insurance companies to mitigate the financial impact of large or catastrophic claims by transferring a portion of the risk to an external reinsurer. This helps the captive manage its risk exposure and avoid being financially overwhelmed by unexpected large claims. Option A is incorrect because while reinsurance may have tax implications, its primary purpose is not to reduce taxable income. Option B is incorrect because reinsurance does not directly provide additional capital, it transfers risk. Option D is incorrect because reinsurance generally involves the captive sharing a portion of the premium income with the reinsurer, not necessarily offering low premiums to its members. Question 10. Formation and capitalization of captive insurance companies. Which of the following is true about the minimum capital and surplus requirements for forming a captive insurance company in Montana? A. Captive insurance companies must have a minimum capital of $10 million, regardless of their structure or the types of risks they intend to cover. B. The minimum capital requirement depends on the type of captive being formed, with different requirements for single-parent captives, risk retention groups, and group captives. C. Montana requires captives to maintain a capital surplus of at least $500,000, regardless of the number of policies they issue. D. The minimum capital requirement is a fixed amount of $2 million for all captive insurance companies, regardless of their operations. Answer: B. The minimum capital requirement depends on the type of captive being formed, with different requirements for single-parent captives, risk retention groups, and group captives. Explanation: in Montana, the minimum capital and surplus requirements for a captive insurance company vary based on the type of captive being formed. For example, a single-parent captive may have a lower capital requirement, potentially starting at around $250,000. A risk retention group (RRG) may have specific capitalization requirements that could be higher or different due to its nature. A group captive may also have different capital requirements based on the number of members and the risks covered. Option A is incorrect because $10 million is an unusually high threshold and does not apply universally. Option C is incorrect because $500,000 is too low for most types of captives, and the capital requirement typically scales with the type and complexity of the captive. Option D is incorrect because $2 million is not a universal amount either, and capital requirements are usually specific to the type of operations. Question 11. Regulatory environment. Which of the following is true regarding the role of the Montana Department of Insurance in the regulation of captive insurance companies? A. The Montana Department of Insurance only provides approvals for the formation of captives but does not regulate their ongoing operations. B. The Montana Department of Insurance is responsible for both the initial approval and the ongoing regulation, ensuring that captives adhere to both state laws and financial solvency standards. C. The Montana Department of Insurance is not involved in any way with the ongoing operations of captives once they are formed. D. The Montana Department of Insurance's role is limited to ensuring captives meet federal standards and is not concerned with state-specific requirements. Answer: B. The Montana Department of Insurance is responsible for both the initial approval and the ongoing regulation, ensuring that captives adhere to both state laws and financial solvency standards. Explanation: the Montana Department of Insurance plays a dual role in both approving the formation of captives and regulating their ongoing operations. This includes ensuring compliance with the Montana Captive Insurance Act, maintaining solvency, enforcing reporting requirements, and overseeing captives' operations. The department ensures that captives meet both state and federal requirements, not just federal standards. Question 12. Formation and capitalization of captive insurance companies. What is typically included in a business plan for forming a captive insurance company in Montana? A. Only the projected premium volume and the types of insurance to be written. B. A detailed analysis of the company's capital risks, reinsurance arrangements, and operational plan, including financial projections. C. A summary of the owner's background and their intended dividend distribution policy. D. A summary of the types of reinsurance contracts the captive intends to enter into without needing financial projections. Answer: B. A detailed analysis of the company's capital risks, reinsurance arrangements, and operational plan, including financial projections. Explanation: when forming a captive insurance company in Montana, a comprehensive business plan is required. The business plan should include a thorough financial analysis, details of the capital structure, the risks to be covered, and the types of reinsurance to be used. The plan also requires financial projections to demonstrate the economic viability of the captive and its ability to meet solvency standards. It's not just about outlining the types of insurance or reinsurance, but about demonstrating sound financial management. Question 13. Risk retention RRGs at group captives. Which of the following best describes the advantage of using a risk retention group RRG for captive insurance? A. RGS are primarily used to write coverage for non-insurance related business risks. B. RGS allow for broader types of coverage, including health and life insurance, which are typically unavailable through other captive structures. C. RGS are typically used by a group of similar businesses to pool risks, thus lowering individual premiums and expanding coverage options. D. RGS are restricted to providing coverage only to large multinational corporations with annual revenues exceeding $1 billion. Answer: C. RGS are typically used by a group of similar businesses to pool risks, thus lowering individual premiums and expanding coverage options. Explanation: a risk retention group RRG is a type of group captive that allows similar businesses to pool their risks and share in the costs of insurance, which can lead to low premiums for each member. This is particularly beneficial for industries where businesses face similar types of risks. RGS do not typically cover health or life insurance, and they are not limited to large corporations, so options B and D are incorrect. They provide specialized insurance to members with common interests. Question 14. Claims management and loss reserving. In the process of loss reserving for a captive insurance company, which of the following is typically the primary factor in determining the amount of reserves required? A. The predicted inflation rate in claims costs over the next 5 years. B. The historical claims experience of the captive's insured entities and an actuarial evaluation of future claims. C. The general economic climate and potential impact on claims costs. D. The average cost of similar insurance policies in the market. Answer: B. The historical claims experience of the captive's insured entities and an actuarial evaluation of future claims. Explanation: Loss reserves are typically calculated based on the historical claims experience of the insured entities as well as the assessment of future claims based on actuarial methods. Actuaries analyze past claims data, trends, and risk factors to project the future liabilities of the captive. Options and C are not as directly related to setting reserves as the actual claims history. Option D is incorrect because the captive's reserves are not set based on external market rates but on its own claims experience. Question 15. Taxation of captive insurance. Under IRC Section 831B, which of the following is true regarding the taxation of small captives? A. Small captives must pay federal income taxes on all premiums received, regardless of the amount. B. Small captives can elect to be taxed only on their investment income, excluding premiums. C. Small captives can exclude premiums received from taxation, provided their net underwriting income does not exceed $2.2 million. D. Small captives are subject to the same tax treatment as regular insurance companies, with no special exclusions. Answer: C. Small captives can exclude premiums received from taxation, provided their net underwriting income does not exceed $2.2 million. Explanation: Under IRC Section 831B, small captive insurance companies can elect to exclude their underwriting income, i.e., premiums, from taxation as long as their net underwriting income does not exceed $2.2 million. This provides tax advantages to smaller captives. Option B is incorrect because small captives are not taxed solely on their investment income. Option is incorrect because small captives may not have to pay tax on premiums under this election. Option D is incorrect because small captives benefit from special tax treatment. Question 16. Compliance and reporting requirements. Which of the following is required for annual reporting by captive insurance companies in Montana? A. Captives must submit an independent audit report by a certified public accountant and submit annual financial statements to the Montana Department of Insurance. B. Captives must only submit a basic financial summary without any third-party audits or actuarial reports. C. Captives are required to file their financial reports only every 2 years unless there is a significant change in operations. D. Captives are not required to submit financial statements to the state as long as they are compliant with federal reporting regulations. Answer: A. Captives must submit an independent audit report by a certified public accountant and submit annual financial statements to the Montana Department of Insurance. Explanation: Montana requires captive insurance companies to submit annual financial statements, which include an independent audit by a certified public accountant as part of their compliance with state regulations. These reports must be submitted to the Montana Department of Insurance to ensure ongoing regulatory oversight and solvency monitoring. Option B is incorrect as more detailed reporting is required. Option C is incorrect because annual reporting is mandatory, not biennial. Option D is incorrect because state reporting requirements cannot be replaced by federal reports. Question 17. Reinsurance and intermediary services. Which of the following statements is correct regarding the role of reinsurance for captive insurance companies? A. Reinsurance is primarily used by captives to increase their capital base and make their operations financially viable. B. Reinsurance is only necessary for captives that offer high-risk coverage, such as earthquake or terrorism coverage. C. Captives generally use reinsurance to transfer risk to a third party, ensuring financial stability in case of large losses. D. Reinsurance is prohibited for captives operating in Montana due to regulatory restrictions. Answer: C. Captives generally use reinsurance to transfer risk to a third party, ensuring financial stability in case of large losses. Explanation: Reinsurance is a tool used by captives to transfer risk to third parties, thereby reducing their exposure to large losses. This is a common practice to maintain financial stability and ensure that captives can cover catastrophic claims. Option A is incorrect because reinsurance is not primarily used to increase capital but to manage risk. Option B is incorrect because all captives, not just those writing high-risk coverage, may use reinsurance. Option D is incorrect because reinsurance is allowed and common for captives in Montana. Question 18. Captive insurance products and coverages. Which of the following is typically NOT, a type of coverage that a captive insurance company would offer? A. Workers' compensation for employees. B. Excess liability for large claims exceeding primary policy limits. C. Homeowners insurance for personal residences of company owners. D. Environmental liability insurance for pollution-related risks. Answer: C. Homeowners insurance for personal residences of company owners. Explanation: captive insurance companies are typically formed to cover business risks rather than personal risks. While captives can offer coverage like workers' compensation, excess liability, and environmental liability insurance, offering homeowners insurance for personal residences is generally not within the scope of a captive insurance company's focus. Captives are designed to insure the risks of the parent company or group of businesses rather than offering personal insurance products like homeowners insurance. Therefore, option C is the correct answer. Question 19. Risk management and loss control. What is the primary goal of a captive insurance company in terms of risk management and loss control? A. To avoid all forms of risk by minimizing coverage and paying only minimal premiums. B. To increase the risk exposure of the parent company in order to maximize profit from premiums. C. To control and manage risks more effectively by tailoring coverage to the specific needs of the parent company and utilizing loss control programs. D. To transfer all risks to a third-party insurer and reduce the need for internal risk management efforts. Answer: C. To control and manage risks more effectively by tailoring coverage to the specific needs of the parent company and utilizing loss control programs. Explanation: the primary goal of a captive insurance company is to provide more tailored and flexible risk management solutions for the parent company or its members. This includes developing customized coverage and implementing loss control measures to minimize risk exposure. Captives are designed to retain some risk while managing it effectively, rather than avoiding risk altogether. Option A, or relying entirely on third-party insurers. Option D. Question 20. Captive insurance audits and financial oversight. What is the role of an independent auditor in the context of captive insurance companies in Montana? A. To perform a compliance audit to ensure captives are adhering to federal tax laws. B. To provide an opinion on the financial health and solvency of the captive based on the audited financial statements. C. To review only the reinsurance contracts of the captive to ensure they are competitive. D. To evaluate the market conditions in the captives industry to ensure its competitive position. Answer: B. To provide an opinion on the financial health and solvency of the captive based on the audited financial statements. Explanation: the role of an independent auditor in a captive insurance company is to review the company's financial statements and provide an opinion on its financial health and solvency. This ensures that the captive is financially stable and capable of meeting its obligations to policyholders. The auditor does not typically evaluate market conditions. Option D, or focus only on reinsurance contracts. Option C. Option is incorrect because the auditor's primary focus is the financial health of the captive, not specifically federal tax compliance. Question 21. Captive insurance structures. Which of the following best describes a protected cell captive PCC? A PCC allows multiple unrelated entities to share the same captive insurance company with separate cells for each entity. B. A PCC is a structure where only one entity can insure its risks and no outside entities can participate. C. A PCC operates like a traditional captive but without the need for a separate legal entity for each participant. D. A PCC is an arrangement where the captive company is protected from insolvency by state-backed guarantees. Answer: A. A PCC allows multiple unrelated entities to share the same captive insurance company with separate cells for each entity. Explanation: a protected cell captive PCC allows multiple businesses to share the same captive insurance company but with separate cells within the captive for each entity's risks. This structure provides each cell with its own assets and liabilities while benefiting from the cost efficiencies of a shared captive platform. It is a common option for smaller companies that want to participate in captive insurance without creating a separate company. Question 22. Reinsurance and risk transfer. Which of the following is a primary reason a captive insurance company might enter into a reinsurance arrangement? A. To reduce its capital requirements by transferring some of its risk to a third-party insurer. B. To avoid the need for loss reserves by shifting responsibility for all claims to the reinsurer. C. To increase its tax liabilities and reduce profits. D. To limit its coverage to a specific geographic region, excluding all other areas. Answer A. To reduce its capital requirements by transferring some of its risk to a third-party insurer. Explanation: captive insurance companies use reinsurance to transfer part of their risk to third-party insurers. This helps captives manage large or catastrophic losses, protect against unexpected claims, and reduce their capital requirements by sharing the financial burden of claims with the reinsurer. Reinsurance does not eliminate the need for loss reserves or increase tax liabilities. Options B and C. Question 23. Actuarial reports and solvency. Why are actuarial reports important for captive insurance companies? A. They provide a forecast of premium prices in the reinsurance market. B. They assess the captive's solvency by evaluating its ability to meet future claim obligations. C. They evaluate the competitive pricing of the captive's products in the market. D. They determine the administrative costs of managing the captive. Answer: B. They assess the captive's solvency by evaluating its ability to meet future claim obligations. Explanation: actuarial reports are crucial for captive insurance companies because they evaluate the financial risks and the company's solvency. Actuaries use historical claims data, projected loss trends, and financial models to determine the appropriate amount of reserves the captive needs to hold in order to meet future claims. These reports are key to ensuring that the captive can fulfill its obligations. Question 24. Capitalization and financial stability. Which of the following is typically the first step when forming a captive insurance company in Montana? A. Developing the reinsurance strategy. B. Securing the required capital and filing the business plan with the Montana Department of Insurance. C. Hiring an independent auditor. D. Purchasing commercial insurance policies for excess coverage. Answer: B. Securing the required capital and filing the business plan with the Montana Department of Insurance. Explanation: when forming a captive insurance company, the first step is to secure the required capital and submit a detailed business plan to the Montana Department of Insurance. This plan includes the projected financials, risk management strategies, and operational details of the captive. Once the department approves the plan, the captive can begin operations. Question 25. Risk retention groups and coverage. Which of the following is true regarding the coverage provided by a risk retention group? RIS are restricted to offering only workers' compensation and general liability coverage. B. RIS can only provide coverage to its owners and not to third-party entities. C. RRGS are formed by groups of similar businesses to cover risks not typically addressed by traditional insurance. D. RRGS are prohibited from offering coverage to members who are not located within the same state. Answer: C. RIGS are formed by groups of similar businesses to cover risks not typically addressed by traditional insurance. Explanation: a risk retention group (RRG) is a group captive formed by businesses with similar risks. It allows members to share in the insurance of uncommon or high-risk areas that may not be covered by traditional insurers. This structure is beneficial for industries with specialized insurance needs. Question 26. Premium taxation for captives. Which of the following best describes the premium taxation for captive insurance companies in Montana? A. Captive insurance companies are subject to the same premium taxes as traditional insurance companies in Montana. B. Captives are exempt from all premium taxes if they are domiciled in Montana. C. Captives are taxed on premiums received, but at a reduced rate compared to traditional insurers. D. Premium taxes for captives are only applied on premiums exceeding $5 million annually. Answer: C. Captives are taxed on premiums received, but at a reduced rate compared to traditional insurers. Explanation: captive insurance companies in Montana are subject to premium taxes on the premiums they receive, but they typically enjoy a reduced tax rate compared to traditional insurance companies. This is one of the incentives for companies to domicile their captives in Montana. Question 27. Regulatory compliance. What must a captive insurance company do to remain compliant with Montana's ongoing regulatory requirements? A. Only submit annual financial reports to the Montana Department of Insurance. B. File quarterly and annual financial statements, undergo an independent audit, and maintain solvency requirements. C. Pay an annual regulatory fee based on the size of the company's capital. D. Submit a new business plan every 3 years to the Montana Department of Insurance. Answer: B. File quarterly and annual financial statements, undergo an independent audit, and maintain solvency requirements. Explanation: to remain compliant with Montana's regulatory requirements, a captive insurance company must submit both quarterly and annual financial statements, undergo an independent audit, and ensure that it maintains adequate reserves to meet solvency requirements. These measures ensure the captive is financially stable and operating within the regulatory framework. Question 20. Captive insurance investment strategies. Which of the following is typically an investment strategy for a captive insurance company in Montana? A. Investing only in short-term, highly liquid assets to ensure maximum flexibility. B. Investing in a diversified portfolio of securities, including bonds, equities, and real estate, to balance risk and return. C. Limiting investments to government bonds to reduce risk exposure. D. Reinvesting all premiums received into the operations of the captive to fund future claims. Answer: B. Investing in a diversified portfolio of securities, including bonds, equities, and real estate, to balance risk and return. Explanation: captive insurance companies typically follow a conservative yet diversified investment strategy to ensure they can meet their financial obligations. By investing in a mix of bonds, equities, and other assets, captives can balance risk and return while preserving capital for future claims. This approach provides financial stability and growth. Question 29. Liquidation of captive insurance companies. If a captive insurance company in Montana is liquidated, who typically takes responsibility for its remaining obligations? A. The parent company or group that owns the captive. B. The Montana Department of Insurance through a state-backed guarantee fund. C. The captive's reinsurance providers, based on the terms of the reinsurance contracts. D. The company's shareholders, who will absorb the losses proportionately. Answer: A. The parent company or group that owns the captive. Explanation: in the event of a liquidation, the parent company or group that owns the captive is generally responsible for covering any outstanding liabilities. The assets of the captive are liquidated to pay off debts, but if there is a shortfall, the parent company or group may need to absorb the remaining obligations. Question 30. Captive insurance governance. Who typically has decision-making authority within a captive insurance company? A. The independent auditors hired to assess the company's financial health. B. The board of directors of the parent company, who oversee the captive's operations. C. The reinsurance providers, who dictate coverage and pricing. D. The Montana Department of Insurance, which manages the captive's operational decisions. Answer: B. The board of directors of the parent company, who oversee the captive's operations. Explanation: the governance of a captive insurance company is typically the responsibility of the board of directors of the parent company. This board oversees the captive's operations, ensures that it remains compliant with regulations, and makes strategic decisions about its risk management, capitalization, and reinsurance arrangements.